Welcome to the CFA Level 1 series of videos. Today I will start several videos dedicated to answering exam style questions. But what is important to me is not the answer per se, but how we approach the question. That is the most important. So let us start. The first question relates to operating leverage. Operating leverage relates to the structure of the cost, that is the fixed cost and variable cost. The more fixed cost we have in our structure, that means the more leverage we have. So the first answer given is competitive nature of the business. That relates to business risk. If you have competitive advantage over rivals, then you will have low business risk. So it has nothing to do with operating leverage. The level and cost of debt. If we have very high debt, we will have very high level of financing cost. That relates to financial leverage. It's not operating leverage. As I mentioned, the answer will be number C, which is fixed and variable. The more fixed we have, we will have more leverage. The second question relates to the number of units needed so that the company just break even, which will achieve no profit and no loss. How to calculate the break even point at which the company makes no loss, no gain? It is by dividing the fixed cost by the contribution. What is meant by the contribution is the difference between the selling price and the variable cost. This difference means this is the contribution of the price towards covering the total fixed cost. The more contribution we get, the less number of units I need to produce so that I can break even. So these are the answer givens, and let us calculate the contribution, the difference between the sale price and the variable cost. That means each unit sold will contribute $2 towards the fixed cost of 10,000. How many units I need so that I reach 10,000 is 5,000 by dividing 10,000 by the contribution. So the answer is clear, number C. The third question relates to financial leverage as opposed to operating leverage. As I just mentioned, operating leverage relates to fixed and variable cost in the production line or the operation. But this one relates to debt, the value or the level of debt I have in the financing or the capital structure of the company, which means how much equity in the capital structure and how much debt I have. If I have huge debt, then I will have huge financial leverage, and then that will result in one of these answers. It results in increases in default risk. That is true. If I have huge debt and huge financial leverage, then the risks that I might not be able to repay this debt will increase, because the more debt I have to serve, the higher the burden on my cash flows, I may not be able to repay. So I will default. But the second part is not correct. Decrease in potential return in equity. Actually, the very purpose of taking debt and high leverage is to increase the potential of gaining more. Why? Because if you introduce more financial leverage, that means you will have more financial risk. The higher the risk, the higher the expected return on equity to compensate the equity holder from burdening or shouldering this extra risk. The answer is B, crystal clear, because it increases the default risk, but I will have higher return potential on my equity. The C is wrong because it does not decrease default risk. Contrary to that, it will increase the possibility or the likelihood that I may not be able to pay and I will default on my debt. Question 4 is about share buyback. This company share price is $5. Market price now is selling for $5. There are 50 million shares outstanding, and the company book value was 900 million. That is the shareholders' equity as appears in the balance sheet. What is the book value per share after the share repurchase of $10 million? These are the answers given, but let us have a small discussion. What's the current book value? Because the shareholders' equity is 900 million and we have 50 million outstanding. So the book value today before the repurchase is $18, sorry. So with this $10 million, how many shares we are going to buy? That is very important. Share buyback is $10 million. Divide the current share price of 5 will give us 2 million shares. So the company is going to buy back its own share. That is 2 million out of 50 million. The remaining number will be 48 million. So the remaining number of shares is 48 million, as I've just mentioned. So the book value will be 900 minus the 10 million which we spent. That will give $800 million. That is the book value of the company after we spent 10 million in share buyback, because once we buy the share from the market, the record is to debit treasury share, which is a negative figure in the shareholders' equity. That will reduce the 900 million to 890 million, because it is a negative figure within the equity part of the balance sheet. So the new book value will be 800 million divide 48 million remaining shares, which lead to this answer, 18.54. The share, if we notice that the share book value increased because currently it is 18 and now it is 18.54. If you are asked why this is the case, because they bought at a price less than the book value. In this way, management should always buy shares when the shares are trading at a very low value, that is undervalued. In this way, management will create value to shareholders. And this may explain in part why companies, when they announce share buyback program, the share price in the market goes up, because they are sending the signal to the market that management, which has private information, believe the current share price is very low and this is why they are buying back. If this is a belief of the management who have every information, then the market will reflect or react by an increase in the share price. The second question, which of the following statements regarding the impact of financial leverage? When we say financial leverage, we are talking about debt and the cost of debt on a company's net income and return on equity is most accurate. The word most sometimes refers to the fact that many answers may be right, but one of them is more accurate than the other three or other two. So be careful when you read the word most accurate. These are the answers given. Using financial leverage increases the volatility of return of equity for the level of volatility in operating income. What does that mean? It means that if we have huge debt, that means we have huge fixed cost, fixed financial cost, not operating cost. The more fixed costs we have, the higher the impact on the profit if sales or revenue decrease or increase by certain percentage. Like for example, if revenue decrease by 10%, then the impact might change the whole profit into loss. But if we don't have that fixed cost, a change of 10% revenue might have a minimal effect on profit. So any change in sales or revenue, the volatility of return of equity year over year will be very high, because any change will increase, lever the impact. keeping the volatility in operating income constant. This looks okay, but let us see, maybe there is more accurate. If a firm has a positive operating profit margin, using financial leverage will always, no, not will always increase the return on equity, because a small margin may also result in a loss. This is definitely wrong. Increasing financial leverage increases both risk and potential return of existing bondholders. That's wrong. Why? Yes, it increases the risk of potential return of existing shareholders, because bondholders will suffer the most because of the high risk. Their bonds will be lower. If we take more loan, the current bond rating will be lower, and this is mainly because of the increase in the default risk. So we will stick to answer A, which is the right answer. Let us now move to question number 6, which is about repurchasing, company buying its own share and the impact this may have on the earning per share. The board of directors of this company is considering buying back worth of 30 million of a stock. The company can repurchase the market price at 50. Now, we have $30 million we need to buy back, and the current share price is 50. How much I can buy? 30 million divided 50 will give me the number of new shares I can buy, which is approximately 600,000. After much discussion, they decide to borrow the $30 million, which will be used to repurchase the shares. So let us not forget that in the future, after buying back the shares, we are going to incur new finance cost for the $30 million. That finance cost should be deducted from the profit before we will be able to buy or to calculate the earning per share. These are the information available. Share outstanding before buyback 30,600,000, and the current earning per share before buying back is this much. Earning yield is definitely the earning per share divided the share price, which is 6.7. After tax cost of borrowing 8%, that means there is new financing cost, which is equal to 8% times 30 million borrowed. That will affect the profitability. The company is going to buy back 600,000 shares. The remaining will be 30 million shares after the buyback. So these are the answers given based on the information above. The company earning per share after the repurchase will be which months? These are the answers. Now the current earning per share is 3.33. Will it be 3.32 or 3.23 or this figure? To calculate this, let us start with the profit. How much the total profit? The current earning per share is this much, and these are the number of shares outstanding. So if we multiply the two, we'll get the current profit of 101 million. We need also to introduce the finance cost of the 30 million borrowed at 8% will give this finance cost. We must deduct the finance cost to get the expected profit after the buyback, which will be 99 million, deducting this from this. If the new profit is 99 million after the buyback, how much will be the earning per share? We should divide this profit by the number of shares outstanding after the buyback. Because we bought back 600,000, we must divide this figure by 30 million, which will give us 3.3166, which is this much, and this is the right answer. Question number 7, the additional risk a firm common shareholder must bear when a firm uses fixed cost financing is best described as. Now, let us assume that the company has got new debt, so it has fixed cost of financing, that is the interest payment. The question is, what is this additional risk I'm bringing to the company by borrowing at a fixed cost? Will this increase the business risk? The business risk has nothing to do with financing. So it is the financial risk, definitely. It has nothing to do with operating risk, because the operating risk relate to fixed cost and variable cost, which is directly related to production. The business risk depends on the sales. That is the sales. The increase or decrease in the sales is the business risk. So the answer is definitely financial risk, because I'm bringing financing cost. Question number 8, paying a dividend is most likely to result in. These are the answer given. An increase in liquidity ratio? Definitely the answer no, because I'm going to pay cash out of my company's bank. That will reduce the current asset, and it will also decrease the shareholders' equity. So no impact on current liabilities, although the current asset is now less. So it will decrease the liquidity ratio. Answer B, an increase in financial leverage ratio. I will come to this. The same impact on liquidity and leverage ratio as a stock dividend. What is a stock dividend? Instead of paying dividend in cash, the company issue new shares and distribute it to current shareholders. Will paying cash dividend have the same impact on leverage as if we issue new shares? Let us see how we, from accounting point of view, those of you who is accounting background will understand what I'm going to say. Stock dividend is just a paper entry. We debit retained earning and credit share capital. This will reduce the retained earning and increase the share capital. So I'm working on the same equity figure, the same category. So the end result will be the same. It has no effect on equity. So there is no change in leverage, because leverage is debt divided equity. This is the right answer, because if I pay dividend, I will increase the financial leverage. How? What is the entry of paying cash dividend? We debit retained earning and we credit bank. Our asset decreased and our retained earning also decreased. If the retained earning decrease, that means the total shareholders' equity is less. When I calculate the financial leverage, I divide debt by equity. There is no change in debt following this cash dividend, but there is a change in equity. Now equity is less. If you are dividing the same amount by less figures than before, it will increase the outcome. Why equity is less? Because we reduce the retained earning. Number 9, as financial leverage increases, what will be the impact on expected rate of return and financial risk? I think we answered this before on the discussion. The financial risk will increase definitely, because you have more fixed financing cost. And what is impacted on the return? If I have higher risk, I should also expect higher return. Both will fall? No. One will rise while the other is fall? No. So both will rise, because if I'm increasing the risk, I should expect more return to compensate for this risk. Let us move to question number 10. This company produces multimedia-enabled wireless phones. The factory incurs rent, depreciation, salary, and other fixed costs totaling 10 million per year. This is the fixed operating cost. Also, the company incurs annual interest rate of 3 million on debt. That is the fixed financing cost. Also, you have two fixed costs, operating and financing fixed cost. Each phone is selling for $200 and the variable cost is $150. That means the contribution is the difference between the selling price and the variable cost per unit, which is $50. Delta operating break-even quantity. That is the quantity needed just to break even is always equal the fixed cost divide the contribution. These are the answers given. Let us see the calculation. The total fixed cost is 10, which is operating, and 3, which is the financing cost, 13 million. And the contribution is the difference between the price and unit variable cost, which is 150. So that will give us a break-even point of 13 million divided 50, which is 260,000, which is the answer number C. This is wrong. I purposely did this wrong calculation to alert you that the question is about operating break-even. It's not about the break-even in total, the operating profit, not the net profit. So we take only the operating fixed cost without the financing, which is the 3, because the question is about this. This is the question answer 200, which calculated this way, which is the 10 million, the operating fixed cost, divide the contribution, which is, be careful about the question, not what you understand. What is written in front of you, read it carefully. I think with this we come to the first video on the question and answer on the CFA Level 1. Please do subscribe to the channel.